Hey traders and investors, it's Serge Berger here. Today I wanted to have a look at just the broader indices and a couple other sectors and things like that to give you an idea of the significance from a technical point of view of last Friday's sell-off. So that's the sell-off from Friday, January 24th, 2014. In last Monday's video from January 20th, I titled it "Some Stocks Are Beginning to Sell Off," and to me that was a pretty clear first sign, aside from some other internals that have been weakening for some time, that stocks are starting to go down a bit of a rockier road. And that's exactly actually what we saw happening on Friday. And my main point, if you're just going to take one thing away from today's video, is that you have to respect the price action and be able to put your opinions on the economy and the trajectory of the stock market aside, at least for the near term, when you see these type of moves. Now, of course, if your time horizon is more than 6 months or so, you might be able to shrug these things off for sure and give it more time. But from a swing trader's point of view, last Friday was actually a very important day. Why? Because we actually finally saw price confirming what the market internals and some other things have been telling us for some time. So what does this mean for the S&P 500 specifically? Again, I don't try to focus too much just on one index, but the S&P is a good barometer, and it does actually act very well technically to react, I should say, to its various moving averages and support lines and things like that. So using a step-by-step approach, we now basically have a couple of very simple things happening. First of all, obviously with last Friday's move, the index has now broken an uptrend, and you can even draw a channel here if you want to. If you go back a little bit further, something like this, right? And you can see that has now been broken with one day, just 1 day of price action. Okay, but that's exactly what we want to see. Now also, we drop below the 50-day moving average, which is this yellow line. So now basically the next target is the 100-day moving average. The 100-day moving average is this blue line, and again, this is no rocket science. I say this every day in my videos. I don't think the markets have to be looked at with any sort of rocket science approach. There's a lot of stuff you can do, and you make a lot of money by just using some common sense and drawing some simple but straightforward but effective lines. The next approach level really is the 100-day moving average, currently around 1762, 1760 as a downside target. If we break below that, we're starting to get into a bit of a more concerning type of move. Why? Because until that time, the S&P would also be holding its support trend line from November 2012, and that's actually a much more important line. So I think right now we're just at least going to head back and retest that for now. I don't know what's going to happen if once we've touched that, but I'm telling you that's the next target right now. So it's all about staying tactical, which means you don't want to get too aggressive on the short side. You obviously want to buy blindly into a dip, but you want to have a look and measure the next targets. So I hope this makes sense. If you got any questions, please let me know, and take care.